Let's be real. For the last decade, saying I just invest in VOO and chill made you sound like a genius. You beat 90% of actively managed funds, got solid 10% annualized returns, and you didn't even break a sweat. But here's the hard truth. That VOO strategy, it's getting outperformed. Right now in 2025. And not by some risky penny stocks or meme coins. No. I'm talking about legit ETFs. Low-cost, high-performing funds that are quietly destroying the S&P 500, and most people have no idea. Today I'm going to show you 3 ETFs that are not just beating VOO, they're embarrassing it. We'll break down the numbers, show you why they're outperforming, and how your portfolio could be 30%, 50%, even 100% further ahead if you'd made the switch. Stick around, because at the end of this video, I'll give you a bonus ETF that has the potential to explode before the end of the year. Have you ever asked yourself, if VOO is so good, why are the wealthy choosing something else? You see, VOO is like a reliable Toyota. Solid, efficient, dependable. But what if I told you there are Ferraris out there? ETFs designed to not just match the market but crush it. In today's video, we're pulling back the curtain on 3 ETFs that are outpacing VOO in performance, dividends, innovation, or all 3. These aren't just alternatives, they're upgrades. I'm going to break each one down in detail, with real-life comparisons, performance data, risk factors, and how they fit into a long-term portfolio better than VOO. And by the end of this video, you'll be armed with ETF picks that could leave the S&P 500 in the dust. Chapter 1. VOO is great, but it has a limit. Ask any financial advisor for a beginner-friendly ETF, and 9 times out of 10 you'll hear one name, VOO, and it makes sense. VOO, the Vanguard S&P 500 ETF, is like the golden child of passive investing. It tracks the S&P 500, arguably the most iconic index in the world, and gives you exposure to 500 of America's largest, most influential public companies. It's low-cost, reliable, and time-tested. But here's the thing most people don't talk about. VOO might be great, but it's not unstoppable. And in some environments, it's actually kind of average. Let me explain why everyone loves VOO. Let's start with what makes VOO such a favorite. For under 3 basis points a year, that's $3 on every $10,000 invested, you get instant diversification across giants like Apple, Microsoft, JP Morgan, Procter & Gamble, and hundreds more. Expense ratio 0.03%. Average annual return, 10-year, approximately 10.2%. Top holdings, Apple, Microsoft, Amazon, Nvidia, Alphabet. It's the ultimate set-it-and-forget-it strategy. And for decades it has worked. Think back to the financial crisis in 2008, the pandemic crash in 2020, or even inflation panic in 2022. VOO may have dipped in the short term, but it always bounced back. Stronger and more stable than most active mutual funds or individual stock picks. For millions of investors, VOO feels like a warm blanket during a financial storm. So what's the issue? The hidden weakness no one talks about. Here's the truth. VOO only performs as well as the companies it holds. And that's where cracks start to show. Let's talk about 2023. The S&P 500 had a fantastic year on paper, up nearly 24%. Headlines screamed, "The market is back." But if you looked closer, the gains were hiding a secret. Nearly 80% of that growth came from just 7 stocks. The so-called Magnificent 7: Nvidia, Apple, Microsoft, Meta, Amazon, Alphabet, and Tesla. If you remove those from the index, the remaining 493 companies collectively returned only about 5%. So while VOO performed great, it did so because of a handful of mega-cap tech giants. That's not true diversification. That's concentration disguised as balance. Now imagine a future where tech takes a breather, where oil, healthcare, or international markets outperform. VOO might still rise, but at a crawl. That's not what smart investors want. They want growth, not just stability. What happens when tech isn't the hero? Here's the million-dollar question. What happens when those same top tech names hit a plateau? Let's look back at history. In the early 2000s, the dot-com bubble burst, and tech stocks underperformed for nearly a decade. From 2000 to 2009, the S&P 500, and by extension VOO, returned a whopping 0.9% per year. That's not a typo, a lost decade. If VOO is built on the backs of tech titans, and those titans stumble, your whole portfolio can feel it. And this isn't hypothetical. What if antitrust regulation slows Google and Amazon? What if chip wars disrupt Nvidia? What if consumers pull back from big tech products? All of that introduces risk to your VOO-heavy portfolio. So the smart play, don't just blindly worship VOO, understand its limits, and build around them. Real-life example, the wake-up call. Let me give you a real-world investor scenario. Meet Jessica. She's 35, works in cybersecurity, and has been maxing out her Roth IRA and 401k for a decade. Her entire portfolio, VOO. After years of consistent returns, 2022 hit. Inflation soared, interest rates climbed. The tech sector, VOO's biggest engine, stumbled. Jessica watched her portfolio drop 20%, while her dividend-paying friends had a softer landing. She started questioning her strategy. Was she really diversified, or just holding 500 companies that all moved together? That's when she discovered something. True diversification isn't just about owning a lot of stocks, it's about owning different types of assets. Growth, value, dividends, innovation, international exposure. VOO gave her breadth, but it didn't give her balance. The smarter path, add to VOO, don't replace it. This isn't a bash session on VOO, let's be clear. It still belongs in most portfolios. But it shouldn't be your entire strategy. A smarter investor approach? Use VOO as a base layer, your stability anchor. Add growth ETFs like QQQM to chase innovation. Include dividend growers like DGRO to create cash flow. Sprinkle in specialized tech like VGT if you believe in AI and cloud. Think of VOO as your strong foundation, but even the best foundation needs a full structure built on top. Chapter 2. ETF-1, QQQM, the silent tech titan. If you're someone who believes that technology and innovation are the real engines of the future, then QQQM is an ETF that deserves a close look. It's like the sleek, modern, younger sibling of the famous QQQ ETF. While QQQ has been a staple for years, QQQM offers the same exposure to the NASDAQ 100, but with a lower expense ratio and a bit more efficiency. What does that mean exactly? Well, the NASDAQ 100 is basically a list of the biggest, most influential tech and growth companies in the US market. Think Apple, Nvidia, Microsoft, Amazon, household names that are constantly pushing the boundaries of what's possible. These companies don't just follow trends, they create them. And QQQM is your ticket to owning a slice of their future. Let me put it in perspective. Over the past 5 years, QQQM has delivered returns north of 110%. Compare that to VOO, the broad S&P 500 ETF, which returned around 82% in the same period. That's a huge difference when you think about compounding over time. Over a decade, the NASDAQ 100 has consistently beaten the S&P 500, showing that focusing on growth and innovation can really pay off. So, why pick QQQM over VOO? The biggest reason is exposure. VOO gives you a broad, diversified look at the entire market, lots of sectors including things like utilities, consumer staples, and financials. It's safe, steady, and reliable. But QQQM zeroes in on growth stocks with a strong tilt toward tech, the sector that has been driving the market's biggest leaps forward for years. Another practical advantage, QQQM has a lower expense ratio than its older sibling QQQ. It costs just 0.15% per year, compared to QQQ's 0.20%. It might sound small, but over years and with large investments, those fractions really add up. But here's what really stands out about QQQM, its focus. This ETF doesn't try to be everything to everyone. Instead, it concentrates on companies that are actually growing, companies that dominate their markets and constantly disrupt the status quo. It's about putting your money behind winners, not just safe bets. Imagine a real-life example. Someone in their early 30s with a long investment horizon ahead doesn't necessarily want the slow and steady pace of VOO. They want their money to grow aggressively, taking advantage of the innovations shaping the world in the next 20 or 30 years. From 2020 to 2024, a portfolio weighted toward QQQM would have nearly doubled the returns of one focused on VOO. That's not just theory, it's the power of targeted growth investing in action. Of course, with higher potential returns comes higher risk. QQQM can be more volatile, especially during bear markets when tech stocks often take bigger hits. It's not a fund you want to rely on exclusively. Instead, think of QQQM as the core growth engine in your portfolio, powerful and efficient, but balanced by other, more stable investments to smooth out the ride. In the end, QQQM offers a compelling blend of innovation exposure, strong historical performance, and cost efficiency. For anyone looking to lean into the future of tech-driven growth, it's a silent titan worth considering. Now let's shift gears and talk about an ETF that's a bit of a hybrid, a blend of growth and income that appeals to investors who want to have their cake and eat it too. Meet DGRO, the iShares Core Dividend Growth ETF. If you like the idea of watching your investments grow while also receiving steady payouts, DGRO is one to keep on your radar. DGRO isn't just throwing darts at random dividend stocks, it's pretty selective. It looks for companies that have a proven history, not just paying dividends but actually increasing them year after year. To get into this fund, companies need to have at least 5 years of uninterrupted dividend growth. That's a sign that they're financially healthy and committed to rewarding shareholders consistently. But it's not just about throwing out dividends willy-nilly. DGRO also makes sure these companies aren't paying out so much that they jeopardize their future. Healthy payout ratios are crucial here, meaning these companies still have enough left over to reinvest in themselves, fuel innovation, and grow their businesses even further. How does that play out in terms of performance? Over the last decade, DGRO has returned around 12% annually. That's impressive, especially considering it offers something extra, steady dividend income. In some years, DGRO has even outperformed broad market ETFs like VOO while consistently paying higher dividends. And speaking of dividends, here's where DGRO really shines. It pays a yield of about 2.5% to 3% per year. Compare that to VOO's roughly 1.4%, and the difference becomes clear. That extra cash flow can make a big difference, especially if you're someone who values income alongside growth. What makes DGRO so attractive is this balance. There are plenty of ETFs out there chasing high yield by focusing on companies that pay big dividends but often lack the growth prospects. DGRO avoids that trap. Instead, it holds quality names you've heard of and trusted for years. Microsoft, Apple, JP Morgan, United Health. Solid companies that not only grow their profits but also reward shareholders with rising dividends over time. Let's bring it home with a real-life example. Imagine you're in your 40s or 50s, starting to think about semi-retirement in the next decade. You want your portfolio to keep growing now, but you also want to begin generating reliable income to lean on later. DGRO fits perfectly in this scenario. It's like having a foot on the gas and a hand on the brake, pushing forward but with some control and stability. If you were to compare that to VOO, you'd notice something important. VOO tends to have a lower dividend yield, slower dividend growth, and a less explicit focus on rewarding shareholders through cash flow. Both funds carry similar risk because they invest in large US companies, but DGRO delivers a smoother ride if you care about cash coming in along the way. In short, DGRO offers a unique combination: growth that's steady and dividends that keep increasing. For investors who want to grow their wealth while getting paid, it's a smart, balanced choice. It's the best of both worlds, really. Alright, now let's dive into something a bit more intense. If you're ready to go all in on technology and innovation, the Vanguard Information Technology ETF, or VGT, is probably the purest way to do it. Unlike QQQM, which mixes tech with a few other sectors like communication services and consumer discretionary, VGT strips it down to the essentials. No distractions, no fluff. It holds over 300 companies, but every single one is firmly planted in the technology sector. This is a fund that's laser-focused on pure innovation. When you look at the big names in VGT, it reads like a who's who of tech giants: NVIDIA, Apple, Microsoft, Broadcom, Adobe. Companies that aren't just playing catch-up but are actively shaping the future. These are the firms driving breakthroughs in AI, cloud computing, semiconductors, and cybersecurity, the fields everyone's betting will dominate the next decade. And those bets haven't been wrong. The numbers tell the story loud and clear. Over the past 5 years, VGT has returned about 125%. That's almost double what you'd expect from a broad market ETF like VOO. But the real eye-opener is the 10-year return. VGT has surged over 400%, an extraordinary figure, especially when you consider VOO has returned around 250% in the same time frame. That's the power of concentrated innovation. If you want a statistic to back up that claim, here's a good one. McKinsey recently projected that artificial intelligence alone could add up to $4.4 trillion every year to the global economy. The companies in VGT are not just spectators in that growth, they're leading the charge. Now, full disclosure, there's a catch here. VGT is more volatile than VOO. When the market takes a hit, tech stocks often get hit even harder. That means you'll see bigger swings both up and down. But history has shown us that long-term investors who stick it out with tech have been richly rewarded with higher highs and much stronger growth. So, who's the ideal investor for VGT? Imagine someone around 25 years old, just starting out with decades ahead of them. They have the time to ride out the bumps in the market and the risk tolerance to hold through volatility. For them, VGT isn't just an ETF. It's a chance to ride the wave of innovation that could define their financial future. Even if you're more conservative, a 20 to 30% allocation to VGT alongside safer ETFs could dramatically boost your total portfolio returns without exposing you to undue risk. It's about finding that balance, letting a portion of your money ride the cutting edge while keeping the rest safe and steady. In short, if you want pure, undiluted exposure to the tech sector's brightest stars and the biggest innovation trends shaping tomorrow, VGT is your go-to. It's the ultimate tech play for anyone who believes that innovation isn't just the future, it's the now. Here's something that trips up a lot of beginner investors. They think if they want more growth, they have to toss out VOO completely. But that's not true at all. The real secret? You don't have to abandon your solid foundation, you can actually enhance it. Think of VOO like your financial home base. It's stable, broad, and steady, covering the large US market with thousands of companies. For most investors, having about 40 to 50% of your portfolio in VOO gives you that reliable backbone. But here's where it gets interesting. Instead of putting all your eggs in one basket, you can add in some carefully chosen ETFs to boost your portfolio's growth and income potential without going overboard on risk. First up, add QQQM. This fund leans more into growth stocks and the tech sector. Think of it as your aggressive growth engine. A 20 to 30% slice here can turbocharge your returns, especially when tech is firing on all cylinders. Next, there's DGRO, the Dividend Growth ETF. This one's like your income booster, quietly compounding dividends over time. Allocating 20 to 30% to DGRO means you're not just chasing price appreciation but also earning passive income that can be reinvested. And if you're young, or just really bullish on technology and innovation, sprinkling in 10 to 15% of VGT gives you that pure tech exposure, the kind that could skyrocket over the long term. But remember, this is the more volatile part of the mix, so keep it to a smaller percentage, unless you have a high-risk tolerance. So what does this look like in practice? Here's a sample split many investors find attractive. 40% VOO, 25% QQQM, 25% DGRO, 10% VGT. This combination historically outperforms VEO alone with only a modest bump in volatility. More importantly, it reflects how today's markets actually work, not how they did 50 years ago. The old 60-40 stock-bond formula isn't cutting it anymore because bonds aren't giving the same returns and inflation keeps nibbling away at gains. Here's a real-world insight. A lot of people in the FIRE, financial independence, retire early community, have moved away from those traditional portfolios. Why? Because bonds, which used to provide safety and income, now underperform so badly that they drag overall returns down. ETFs like DGRO and QQQM help bridge that gap by combining income and growth in a smarter, more flexible way. Bottom line, building a smarter portfolio isn't about chasing the latest shiny ETF or abandoning what works. It's about balance. Use VOO as your anchor, add growth and dividends with QQQM and DGRO, and sprinkle in some pure innovation with VGT if you can handle the ride. That's the modern recipe for long-term success. Look, VOO is a legend. It's been the go-to ETF for decades, and for good reason. It's simple, reliable, and broad. But even legends need challengers, especially when the world around them is changing fast. We're living in a new era of investing. The old playbooks are starting to feel a bit outdated. The portfolios that will thrive in 2025 and beyond, they won't be the ones stuck clinging to the same old safe ideas. They'll be flexible, forward-looking, crafted with precision. That's where ETFs like QQQM, DGRO, and VGT come in. They don't just follow the market, they lean into the trends shaping it. Technology innovation, rising inflation, and global shifts aren't just buzzwords. They're forces redefining where the smart money goes. More young investors are jumping into the market, bringing fresh energy and a different mindset. They want portfolios that can keep pace with rapid change, that balance growth with income, and that tap into tomorrow's biggest opportunities today. So here's the bottom line. Don't just invest to survive the market, invest to dominate it. If this video helped you see ETF investing in a new light, do me a favor. Hit that like button, subscribe if you haven't already, and drop a comment below with your favorite ETF or your own portfolio mix. Let's build wealth the intelligent way, together.